CMHC. Well, I want to talk about Canada Home Mortgage Corporation and what that is. All right. CMHC is a form of insurance that you can purchase when buying a home, and you're only putting 5% to 20% down, and sometimes 25% because the bank will say, just pay, we'll pay the premium, and there is no premium. But who does it protect? It protects the bank. I will give you an example. Let's say you take a mortgage out and the mortgage amount is $350,000. But you start going bad on the debt at some point and you end up owing, say, $340,000. And in a forced sale through foreclosure, they can only sell it for $300,000. And there's lawyers' fees, and there's commission from realtors, and yada yada. And there's a deficit of $100,000. The bank gets that money. They apply to CMHC. CMHC gives them the $100,000 that they're short. Who pays CMHC? Well, you paid a fee, but it wasn't to protect you. They will garnish your wages. They will try to get that money back through a judgment. So CMHC isn't always our friend. However, when we don't have enough down payment, what are we going to do? We have to dance with the devil a little bit. And CMHC offers other programs which are really unique. One of which is called New to Canada. The New to Canada program is a time-tested program. People who have come to Canada from other countries have proven that they will pay on mortgages, actually more so than most people. They believe in home ownership, and they don't believe in skipping out on payments. In fact, they'll do what it takes in most cases. So, just like all insurers, they evaluate who's a better risk and who's not. And because New to Canada, those people tend to be at better risk, they give them a few things that they can slide out on. One of which is credit. Lots of times they don't have their credit built up, but the government allows them to still purchase a home, 5% down. And that is a wonderful project and a great program for anyone who is new to Canada. Another program that CMHC offers is the new homebuyer incentive program. Now, I'm not going to explain every detail of this program. This program is a little complicated, yet for some, it could mean the difference whether they get into a property or not. Ultimately, the government becomes a second mortgage to you, and they don't charge any interest, but they charge exactly what you would have gotten out of it. So I will give you an example. You buy a $400,000 home, you need a $20,000 down payment. They will give you the $20,000 down payment. That is 5%. Now let's say you sell that home in 10 years and it's worth $500,000. You have to give them back 5%, which is $25,000. Is that a bad thing? No, that's not a bad thing. If the property goes down in value, that's when it can get a little tricky. Now, a lot of people don't think it's tricky that way, but I can tell you, I think it could put people a little underwater. So let's say that $400,000 home is not worth in 10 years 500, but now it's worth 350. And you've paid down to, say, 325. You will still owe the government 5% of 350,000. What is that? 1750. But if you don't have the money, how do you pay them back? So it is tricky, and you need to talk to a mortgage broker more about whether or not the home incentive program is really what you need. That's our portion on insurance. This video has been brought to you by Anita and Josh McKinnon with McKinnonHomes.ca, brokered by eXp Realty. Thanks again for watching.